This is Ronald Reed. After he died in June 2014, his face was plastered all over the media because of one secret he hid from everyone, including his own family. Ronald amassed a $8 million fortune. Yeah, so what? Millionaires die every other day. Ronald was different. He grew up on a poor farm, finished only high school, and worked as a janitor for minimum wage for most of his life. Check this out. In the 2000s, janitors made about $22,000 a year, which Ronald was able to transform into $8 million. And I know how he did it. Lesson 1, the wealth formula. The most important thing Ronald knew was the secret wealth formula that school didn't teach you. The formula is how much money you have coming in versus how much money you have going out. So income minus expenses equal cash flow. If you have a positive cash flow, you have money left over. If you have a negative cash flow, then you're falling into debt. In the book, The Psychology of Money, Morgan Housel writes that true wealth is actually the money that you have not spent. For every 5% of extra income that you save, you can retire multiple years earlier. Check this out. Let's say your monthly income is $5,000. If your cash flow is $0 or negative, meaning your expenses are $5,000 or more, then you'll never be financially free. You'll need to work until the day you die, unless you're a trust fund baby or whatever. However, if your cash flow is $5,000 and your expense is $0, and you can maintain this $0 lifestyle after retirement, you can be financially free right now. Who the heck has $0 in expenses? Simple, right? Here's where it gets fascinating. If you have expenses between $0 and $5,000, so a positive cash flow, after saving enough, you can make your money work for you and snowball it into future income. And when that future income can cover your living expenses, you're golden. Take a look at this. Assuming you have an annual income of $65,000 and you can save 10% or $6,500, you can be financially free in 51.4 years. But if you can just save 5% more at 15%, you can be financially free in 42.8 years. For just 5% more effort, you can shave off more than 8 years that you need to work. The average American spends nearly $18,000 every year on non-essential items. Come on, do you really need to spend $173 on takeout every month? Lesson 2, the numbers. How much money you've saved up by your current age is key to measure if you're financially on track to be a millionaire by 65. And you need to know this so you can adjust your finances before it's too late. Check this out. If you start saving at 20 years old, you need to save $204 per month to retire a millionaire by 65. If you start saving at 30, you need to save $443 per month. At 40, $1,030 per month. At 50, $2,795 per month, and so on. Like most things in life, the earlier you start, the easier it will be because of time. But since I don't know your personal financial situation, these calculations are based on a few assumptions. 1, you're starting with $0 in savings. 2, you can grow your investments by 7% every year. And 3, you're increasing your monthly contributions each year by 2% to keep up with inflation. So if you're depositing $100 per month in year 1, you will be depositing $102 per month in year 2, and so on. Of course, this math changes depending on many factors, but the earlier you start saving, the better off you'll be. What's the best way to save money then? Here's how I do it, and I'll probably get a lot of hate for this. Stop budgeting and stop tracking everything. What the heck are you talking about? Hear me out. Do you think that wealthy people have Excel spreadsheets where they record this?
On June 21st, I bought 2 Popeye chicken sandwiches for $10.51.
No, they don't. I still budget, but in a very unique way that makes it easier and saves me a bunch of time. But hey, don't get me wrong, detailed budgeting could still be a good idea if you have a spending problem or if you're not financially stable. Here's what I do and a better example of what the rich actually does. Guideline automation. I automatically deposit my paychecks into my checking account, and each month I automatically transfer the amount I want to save into a savings account and the amount I want to spend into a spending account. My spending account includes my fixed monthly bills, typical living expenses, etc. And here's the trick. Since I know my fixed monthly spend, I can set spending targets for food, entertainment, travel, shopping, etc. And at the end of the month, I automatically know what I didn't use because that's the money left over in my spending account, which I can either invest with, save, or roll over to the next spending month. If you want to know the free app I use to help me with all this, follow me on Instagram and send me a DM with the message Apple Bottom Jeans. Also, beware of scam imposter accounts. You can get a direct link to my Instagram in the description down below. And remember, I will never ask you for money. This guideline automation strategy isn't for everyone, but my goal is to simplify personal finance as much as possible, because psychologically speaking, the more obstacles we have in the way, the less likely we are going to do it. Lesson 3, water the plants. Okay, so back to income, and it's not gonna be what you think. In the book, Rich Habits, Tom Corley shares that more than 75% of millionaires came from a poor background and were self-made, just like Ronald Reed. But there is one thing that he noticed all millionaires have in common, and the IRS also verified this fact. And it's that nearly all of them had turned that like button into a beautiful black. Go on, give it a tap. But seriously, nearly all of them had multiple income streams, anywhere from 3 to 7. Ronald Reed had 2 main ones, his janitor job and a second one that I'll share later on. There are 2 main benefits to having more than one income stream. One is you reduce your dependency on any single one, including your full-time job. You might think your full-time job is safe and secure, but it's actually much riskier than you think, because the moment your boss says those dreaded words,
You're fired.
you're financially ruined. 2, you can supercharge your cash flow formula. If your monthly expenses is $3,000, you can try and live more frugally, maybe reduce your spending to $2,400, but there will always be a limit to how little you can live off of. Even eating nothing but instant ramen and drinking water requires money. But if you manage to earn just a little bit more, even $100 a week, your cash flow will increase substantially. To earn more money, you could do the traditional thing. Do a bit of overtime, ask for a raise, get extra qualifications, and get a better job. Or do what I did when I was working full-time. Start a side hustle. Side hustles are a great way to make extra money. In fact, this YouTube channel, it all started as a side hustle back in 2020, which thankfully I was able to turn into my full-time job. Depending on the side hustle you start, it will require you to work extra couple of hours every few days. But trust me, it'll be worth it in the end.
But listen, I get it. Maybe starting a new income stream is the last thing on your mind because you're under a lot of high interest debt, which by the way, the total debt owed by the average US household is a whopping $155,622. So instead of paying off a bunch of debt and bills separately, what if you could consolidate your debt with a personal loan at a smarter interest rate that only requires one fixed monthly payment and has a super clear payoff date? Sounds cool, right? That's where Upstart can help out, the sponsor of today's video. Upstart has helped over 1.8 million customers with their financial journey already. And what's cool is that Upstart knows that you're more than just your credit score. So instead of just solely looking at your credit score like every other financial institution out there, they also look at other things like your income, your employment, and other stuff that you provide in your loan application with the goal of finding you a smarter rate. If you're interested, you can discover your rate in just 5 minutes, and you can even check your rate without impacting your credit score for loans between $1,000 to $50,000. Once approved, you can receive your funds in as little as 1 business day. Find out how Upstart can lower your monthly payments today when you go to upstart.com/Vincent or click in the link in the description below. That's upstart.com/Vincent. Don't forget to use our URL to let them know we sent you.
Lesson 4, beyond the wealth formula. Ronald didn't become a multimillionaire from just perfecting this cash flow formula. He had one other secret up his sleeve. When he died, the truth finally came out. No one, not even his family, knew about this. Ronald had been investing in about 95 different stocks throughout his lifetime. And after going through all of his stock picks, I found one common theme throughout all of them, and this is where it gets interesting. Investing your positive cash flow is the key ingredient to building wealth, but it's vital you do it correctly. I'll show you the easiest way to get started. But first, here's the mistake that you absolutely need to avoid. You've probably heard a lot about day trading before. You see it on TikTok, on Instagram, on YouTube, about people analyzing charts, buying and selling 20 different times a day, hoping it goes up, thinking it's really exciting and is the key to getting rich. But here's what they don't tell you. 90% of day traders lose money. Ronald, in all his wisdom, didn't day trade. Instead, he was an investor who focused on the fundamentals of a company, which meant he analyzed the company's intrinsic value and made sure the investment made sense both quantitatively and qualitatively. So no, he wouldn't have YOLO'd his life savings away on meme stocks like GameStop and AMC. Speaking of stocks, here are 3 freebies just for you. You can get 2 free stocks valued up to $7,000 with Moomoo if you deposit $1, 3 free stocks valued up to $6,300 with Webull if you deposit $1, and $5 in Bitcoin for free if you sign up with Coinbase through my links in the description down below. Lesson 5, rice and chess. There is one single investing mistake that everyone commits that costs them hundreds if not thousands of dollars. But first, I want to tell you a story. Centuries ago, there was an emperor in China who learned about chess and was so impressed by this game that he offered the game's inventor one wish, anything he wanted. The inventor humbly said that he just wanted rice. 1 grain of rice on the first square of the chessboard, then 2 grains on the second, 4 on the third, and so on. doubling all the way through to the 64th black and white square. The emperor quickly agreed, smirking, thinking that this was such a silly and simple request. But this single promise led to the collapse of his entire dynasty. By the 30th square alone, the emperor's debt had amounted to over 1 billion grains of rice. By the time he reached the 64th square, the emperor owed him 18 quintillion, with a Q, grains of rice, bankrupting the entire kingdom. And this is exactly what Ronald Read did. His plan was to invest for the long term, where his money compounded for decades, and every 2 weeks, when he got his janitor paycheck, he would keep adding to his investments. Let's say you save $1,000 in year 1 and you get a 10% interest on it. You'd make $100. In year 2, you'd make $110 because your investment is no longer just $1,000. With your 1-year interest, it's now worth $1,100. After year 2, your investment is worth $1,210. So your interest made in year 3 will be $121. Over time, you earn interest on the money you originally saved and the interest you received for that original amount. If we graph this out, we can see an exponential growth curve, which is why Albert Einstein said compound interest is the 8th wonder of the world. And this is exactly how 99% of Warren Buffett's wealth was actually earned after his 50th birthday, according to the book Psychology of Money. When the book was written, Buffett's wealth was $84.5 billion, but $84.2 billion was achieved after his 50th birthday. And it's because of the magic of compounding. Buffett started investing since he was 10. By the time he was 30, he already had $1 million. Lesson 6, your response. What would you do if you see the stock market crash 50% tomorrow? Obviously, I'm gonna sell. I don't wanna lose any money. Throughout Ronald's life, he witnessed 11 stock market crashes and bear markets. And yet, he still held on to his investments because he knew this one secret. You can't time the market. And your best bet is to just continue investing for the long term, regardless if the market goes up or down. Bullcrap, this Instagram trader I follow says the market's gonna crash in 2 months and 3 days. I'm not touching the market until then. Oof, good luck. When you think you can time the market, you're making 2 bold guesses. 1, that you know when the market has reached the bottom and you got out exactly at the same time. And 2, you know when the market is going back up and you buy in at or very near the bottom. And according to my calculations, when it comes to predicting the future, the odds are not in your favor. The University of Michigan conducted a study that measured returns from 1963 to 2004 and found that 96% of the positive returns over that period came from just 0.85% of trading days. Separately, one of the top equity analysts in the world, Andrew Stotz, observed a 10-year period from November 2005 through October 2015 and ran the data through several simulations and concluded that if you miss the 10 best market days over the specified 10-year period, you would stand to lose on average 66% of the gains you would have captured by staying in the market. In non-finance jargon, when the market moves up, it will move up very quickly. And if your money is on the sidelines, you'll risk missing out on some of the best days the market has to offer, so stop trying to time the market and stop panicking. Lesson 7, the best investment ever. What interested me the most was how did Ronald learn so much about investing? And the answer I found was pretty simple. He actively sought out knowledge. Ronald went to his local library, read the Wall Street Journal and other things for free. He talked to his neighbors that worked at banks to learn more about money and how everything works. One thing you need to realize is that no thing deserves to get a chunk of your money more than yourself. The wealthy loves to educate themselves to gain information because of the value they get down the line. And thankfully, you're doing the same thing right now by watching this free video. Even when it comes to reading a book that you have to buy for $8, you're essentially downloading decades worth of knowledge from the author for just a few bucks. Or even with this 100% free investing newsletter that I send out every morning called the Daily Market Briefs that summarizes the stock market news that you can read in just 1 minute. Link in the description down below. Lesson 8, the most vital information. Nobody is perfect, not even Ronald Read. As intelligent as he was, some of his investments failed miserably, such as Lehman Brothers, which the company collapsed during the 2008 financial crisis. But despite this setback, he still continued to invest, and he was able to get through this because his investments were diversified with other stocks. Look, we all make mistakes. Maybe you made a bad investment in the past, you think you're starting too late, or you bought something really unnecessary. But I'm here to tell you that it's okay. Don't give up. But one thing you absolutely cannot make a mistake with is how you save your money. Click on this video to learn why you're saving your money wrong and why you need to do this instead.